Alibaba just reported some pretty weak results, and yet the stock is bouncing higher, 1 to 2% higher. Looking at it across the board, weak growth, effectively flat revenue. Their China core segment down 1%. Even some of the historically faster growth segments posted very sluggish revenue growth. 2% for international, 5% for local consumer, logistics only 5%, cloud only 10%. This is pretty darn weak for this business. Now let's focus on their core China commerce segment, because that's 70% of their revenue and pretty much all of their profits at this point. And you see that revenue is flat, down 1%, but that doesn't really capture the full story, because their customer management segment, which is historically their cash cow, very high margin, effectively commission revenue and advertising revenue tied to Taobao and Tmall, that was down 10%, whereas the lower margin direct sales and wholesale businesses were up significantly. And that's part of the reason why you look at their core profitability, and that's down 14% year over year. This is not good. They talk about how GMV, or the amount of business generated on Taobao and Tmall, was down mid-single digits year over year due to effectively the impacts from COVID-19 resurgence that they saw largely in April and May. So this is going to be the theme that we're looking at with Alibaba, is trying to figure out how much of these challenges are just because of, COVID versus sort of self-inflicted wounds versus, the CCP sort of cracking down on, this zero tolerance approach to COVID and, letting people effectively, feel comfortable transacting and going out and about. But looking at expanding beyond China commerce, looking at their international segment, which historically was growing nicely, this too reported very weak results. You're looking at 2% revenue growth, which was mixed once again. Their retail segment, which I'd expect would be higher margin, declined 3%, whereas their wholesale was up 12%, still significantly unprofitable. And they're talking about pressures from a higher US dollar, changing European tax rules, and the impact on logistics from the Russia-Ukraine conflict and what's going on there. And so that's clearly not great. Looking at cloud is also pretty darn weak, only 10% growth. This segment used to be growing 30, 40% just, in the last couple of years. So looking at 10% growth, management effectively talks about how it's a really mixed picture, saying that some non-internet industries are slowly recovering, while they're still seeing softening demand from other customers in the China internet industry. So overall, very mixed picture for Alibaba Cloud. And, it is nice to see that they're effectively break even. So it's not a huge cash burn for them at this point in terms of their core operations, unlike almost everything else. But looking at Alibaba, looking at their results, penciling it out, looking at how they actually performing, one nice aspect of their most recent quarter, despite the weak top line, despite the weak revenue, is that they are still generating significant free cash flow, around $3 billion US dollars, 22 billion RMB. And so, and on an annual basis, you're talking about, let's say 12 to 15 billion US dollars in free cash flow. And they're using that to buy back stock. And at this pace, this implies that they effectively trade at 19 times free cash flow. That's not an adjusted figure. That's saying, hey, based on the free cash flow here, annualize it, and keep in mind, this isn't supposed to be the super strong quarter. You look at this, you annualize it, you're trading at 19 times free cash flow, and they're using that cash flow to buy back stock. When you factor in their cash on their balance sheet, it's probably trading closer to 15, 16 times. So that is a free cash flow figure that includes, that's when you layer in all their loss-making segments. So even when you factor in all these, their international segments, their logistics segments, their innovation segments, you look at all that it had huge losses. And even after that, they're still trading at under 20 times free cash flow, and they're using it to buy back stock. So if you're under 20 times, you think about that free cash flow multiple, and you think about cash being returned to shareholders, so far you're looking at a 3% decline year over year in shares outstanding. So if you use that free cash flow like they're doing now, which is what I like to see, to buy back stock, if this business isn't in a terminal decline, which I don't think it is, I think this is more of short-term pressure, then, they're buying back stock possibly quite intelligently. And reducing the pie over time, so overall making it better for long-term shareholders. I, in full disclosure, do own some Alibaba stock. I own it on the Hong Kong, stock exchange, and I bought it through Interactive Brokers, which, there's a link below in the description of this video if you're interested in, checking out the Interactive Brokers app. And so looking at Alibaba, still have sizable, net cash position, generating real cash flow, and they're buying back stock. This is what I like to see. The question is, where does Alibaba stock go from here? It certainly has gotten hammered. If you're struggling with this investment environment, consider unrivaledinvesting.com for new ideas and a community of like-minded investors. Let's keep going. So looking at Alibaba, I've called this out previously, but yes, it was not a great quarter. But when you look at all these different segments, international commerce, local consumer services, their logistics, their cloud, their digital media, their innovation, most of these are loss-making, except for cloud, which is effectively break-even. And you look at China commerce, and if you were to say, okay, let's tax effects this, slap on, let's say, a 25% tax rate, annualize it, then you're looking at 13 times just for their China commerce segment. If you throw in their cash, now you're probably talking about closer to 10 times earnings for a business that services over 1 billion Chinese consumers every year. And so that's the question of, does that really make sense? Or will this recover? And is China sort of facing short-term pressures like a property crisis, like COVID restrictions, that's holding back the results? And if that's the case, and you're just getting this one segment, you're effectively paying a very reasonable price for one segment and getting everything else for free, could you have very attractive returns in the future? Management called out, yes, they're effectively getting hurt from COVID. They talked about how retail sales decreased. This is on a national basis, decreased year over year in April and May due to the resurgence of COVID in Shanghai and other major cities, and has slowly recovered in June. So that is a favorable data point. This might be part of the reason why the stock has recovered, but it is worth understanding, look, China has a very different policy response to COVID versus many other countries. They're still they do the COVID zero policy, and that should impact commerce. That should impact, the consumer sentiment of hey, do I really want to spend money if I'm not going to be able to get to work and make an income? So you do see these sort of challenges. And I would argue you definitely still have this major property market slump and weak demand. And you do, this is one of the China mouthpieces, effectively saying, look, relying on infrastructure investment alone is not enough to bolster the economy. They're going to need to see some sort of step up from the government to say, hey, we're offsetting this property implosion. And I think part of the reason why the stock is actually recovering on these arguably very weak results is based on the commentary that management said about what they're looking at. Yeah, so April and May were hurt because of the zero COVID policies. But they're talking about signs of recovery certainly appeared, in particular with the recovery of delivery and logistics capabilities, the normalization of logistics, and certainly in this year's 618 Shopping Festival, where they said very good performance with positive growth. And they're talking about this positive trend continuing through July, and we expect that July will be even better than June. So they're saying, yeah, it creates sort of this hope for investors or investment analysts to say, oh, okay, if July was better than June, and this certainly was a very weak quarter, does that suggest this quarter was sort of the bottom and it actually starts getting better from here? We'll see. I think there are some real macro challenges. There's some micro challenges from a competitive dynamic, that you see going on, but there certainly are some macro challenges that are holding back, Alibaba and several other Chinese companies. So looking at the valuation, thinking about, where does this go from here? Just focusing on their China commerce. That's 70% of the revenue, ignoring the other 30%, ignoring all the loss making, ignoring cloud. Looking at this business, which was effectively down 1% this quarter, let's assume they effectively get to 0 to 7% growth this year. We'll see how they perform. And then if you think that they can resume growth in the years ahead, from 5 to 10% growth in the years ahead, and you think their margins will either stabilize currently around 31%, either stabilize at 30, and this keep the high scenario that I'm penciling out, versus go to 25%. So further haircuts for this segment. if you assume, let's say 25 to 30% margins for just this one segment, and you assume that they're able to get back to growth, assuming some sort of mid-teens earnings multiple, then you're effectively saying you're currently getting this segment. This segment is either worth the entire market cap or worth double. Effectively, that Alibaba stock could double from here just based on this one segment if the economy, if Alibaba reinvigorates and you start seeing growth in this business again. And that's going to be the question. That's going to be, if you're going to potentially get hundreds of % upside from Alibaba from here, you're going to need to start seeing better results. And you certainly did not see it this quarter. Now, keep in mind, this is part of a hypothetical valuation framework. Of course, stock price can go way higher, way lower. A lot depends on the execution. A lot depends on the sentiment. How does, geopolitics definitely plays a role. But I look at this and I'm thinking Alibaba shares, which I personally buy, so I ignore the U.S. dynamic of, hey, we might delist the ADS shares. So I just buy it on the Hong Kong exchange, once again, using Interactive Brokers. And pretty simple, pretty straightforward how to use. Link below in the description of this video. And I look at this and I'm saying, there's definitely some asymmetry here in terms of China commerce. If let's say China, the Chinese Communist Party steps up and starts saying, hey, we need to start helping juice the economy. It's taking too much pressure from our zero COVID approach and the property lockdown. And so if you start seeing real credit changes, then you might start seeing the economy improve and ultimately get to the growth that you need to see for Alibaba to re-rate potentially hundreds of % upside. Now that's the question of, will that happen, or will, the economy continue to sort of slug it out? You don't get that credit impulse that sort of drives the economy higher, or do you continue to get sort of really tough zero COVID approach that results in sort of weak results, so the company sort of stagnates over time, or worse, you get some sort of geopolitical flare-up. So that's the risks to be mindful of, or at least some of the risks to be mindful of. If you enjoyed this video, I still own, my Alibaba Hong Kong shares around a 3% position. So I'd love to hear your thoughts, on Alibaba. If you have an opinion, in the comments below. And if you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button, and thank you so much for watching Unrivaled Investing.